All right. I think the meeting is being live streamed. This is the Investing Power Hour number 79 on Chit Chat Money. My name is Brett Schafer. I am joined, as always, by Ryan Henderson. We're chugging along here until earnings season happens, but it looks like we have plenty of news this week. So, Ryan, I guess we'll get right into it. Any topics you want to hit? I know you made a lot of notes this week, so you took basically put in all the big news stories, and I think there's going to be some fun ones.
Yeah, it is. It's almost earnings season again, which is nice. Give us a little news. There have been some recent earnings which were interesting. Costco reported earnings and maybe showed us a little sign of the bottom, the market bottom here. We'll talk about that in a second. There was Michael Lewis, the famous author of The Big Short and Moneyball, released the book Going Infinite, I think is what it's called. And it's basically this autobiography around SBF, or Sam Bankman-Fried, and the FTX. Well, originally it was meant to be kind of this
and not
book about him, kind of a hype book describing the genius that he was. And then right as he was finishing up, FTX collapsed. And so he's had to, I think, backtrack some of the stuff, but he's been very much a public defender of Sam Bankman-Fried. I would say he's been a public defender throughout a lot of interviews, and kind of had a lot of skepticism. And there's concerns that people kind of think he might be throwing his reputation out the window. So there's that as well. Spotify's adding audiobooks.
Let me be clear for the listeners, not an autobiography, a biography. But yes, it should be very fun to discuss all that stuff there.
And then there's a new Michael Mauboussin, some people call him Malbosin, paper. Not really sure which one it is, but he released a new paper, and I haven't read the whole thing, but there were some interesting tidbits in it. And on page 37 of this, I mean, it's a long presentation, there was this list from Morgan Stanley of wide moat businesses. And I think it's kind of fun to comb through some of those and see what they consider to be wide moats. Honestly, just looking, we've studied some of the businesses that are on this list, and looking at them, it looks like a great place to potentially do some fishing for new stocks to own, because there really are, I don't know all of them, but it looks like some really high quality businesses in that segment. So we can get to all of that. Do you have anything?
I was going to talk about the Google Pixel. Well, you had some of the stuff I wanted to talk about as well. So it kind of depends who gets to the sheet first. But yeah, I wanted to talk about Google Pixel market share gains. It's been pretty impressive. And they just launched the new one this week, or not launched, but did their whole, as every tech company does today, the bring out some vice president and try to do a Steve Jobs thing for an hour. No way I'm going to watch that presentation, but I guess we can talk about the specs there and how maybe they're trying to attack this market and gain some shares. So yeah, I think some of that could be some other stuff. There's plenty, I think, for us to discuss this week.
We do have an early comment from John Gallegos talking about Nelnet. Yeah, we own Nelnet, and the price has been coming down over the last, I'd say, 2 weeks. And he says he's loading up and buying more shares. I don't think we can really say what we've been doing actively as of late, but Nelnet's our largest position.
Everyone do their own thing.
Nelnet's our largest position, and it is kind of interesting. We've been trying to peg why it's kind of coming down, and I think probably the most realistic reason is just around interest rates rising and potentially tightening the spread on their loan book. But there's always a million reasons that something could be going down. So it's been fun to guess. The good thing is they got a management team that buys back a lot of stock and does so opportunistically. So chances are you're not the only one buying. I imagine management is as well.
Yeah, I think.
Should we dig in?
Yeah, go right ahead. What do you want to hit first?
I kind of want to start with Costco.
All right, that's a fun start. Yeah, it's more whimsical, right? Or maybe you can hit the earnings as well. But the first thing you have here is a little more fun.
Yeah, I didn't take a deep enough look at the earnings, but apparently this kind of came out during the conference call, because I didn't know this existed, but apparently Costco now sells gold bars. on the conference call, the CEO said, I've gotten a couple calls that people have seen online that we've been selling 1 ounce gold bars. Yes, but when we load them on the site, they're typically gone within a few hours and we limit 2 per member. You can only see the prices of these if you're a member. According to some member online, they cost just under $2,000 for a 1 ounce bar. I had no idea. They are literally selling just pure gold bars online. And they're selling out quickly. Is this a sign of the market bottom?
No, I don't think so, because everyone has loved gold forever. And right, there's always a certain section of the population that absolutely loves gold, and they can do that. And I'll be fine. But, it's not going to affect me. If they want to buy gold, go right with them. And if Costco wants to sell that to drive more customers and retain their subscribers to the membership plan, hey, that's all right with them too.
It is interesting.
Yeah, no one's Costco, it's not hurting anyone, right? It's just there. People want to spend all this money on some metal. It's good with me.
It's funny that Costco can just list this stuff and just instantly everyone buys it. Like, it's just gold bars. I'm sure there's other places you can buy it too.
Well, I'm sure they're selling it unless
they say they're selling it at a fair price.
Yeah, they're selling it at a good price. That's where a lot of other places you have those fees and stuff at a metal shop or wherever you would go. It's interesting though, what do you think of?
I wonder if the other retailers will copy them. Something tells me Walmart's not going to be offering gold bars.
Well, the shrink issues, yes. Yeah. What do you think of how gold is still so enticing to so many people? Do you think it's because there's such an industry around it with the perma bears and the, quote unquote, buried in my backyard people, that it's just perpetuated? There's so many ads around it. There's so much money to be made selling gold. What do you think keeps it around and so relevant, even though it really does nothing?
Well, I mean, it is pretty shiny. Like, it does look cool.
That's true.
I think
that is true.
I mean, people wear jewelry, gold jewelry. I think there is like a literal, like, optical appeal more so than.
Yeah, I guess beauty's in the eye of the beholder, but yeah.
I don't think people are looking at it. Well, a lot of people are, but I think a lot of people are just attracted to it because of its whatever optical appeal. And then maybe
then why are they buying the
doomers? What?
Then why are they buying the bars? What I would say.
Yeah, I mean, the gold bars still look pretty cool. It's just like, I don't know.
I don't think that's the sign of the bottom. Honestly, it could be the sign of the top, because
there's too much excess to spend on gold bars.
Yeah, exactly.
Maybe.
But what did you look at Costco's earnings at all? Or maybe I'll pull them up while you're talking.
No, I really didn't. It's one of those I just really haven't followed because the multiple just has always kept me out.
Yeah. Well, here's a question I put out this week after seeing Costco report strong earnings again. Now, it's hard because we don't really, the Amazon is a part of a bigger business, so we don't exactly know how profitable it is, right? Stuff like that. But let me give you one business. You have Costco, the full business that you could buy, or you could buy Amazon retail, which could include the first party, third party business, Amazon Prime subscriptions, but just exclude Prime Video, right? Because the majority of it is subscribing for the shipping services, and then add on the advertising business as well with the sponsored listings, because that's a big part of the retail segment as well. From an earnings perspective, what do you think deserves a higher multiple, which I guess would mean, what do you think has a better combination of competitive advantage plus potential growth? I think it's a tough question. I think they're both pretty darn strong here.
I think Costco still ranks a little higher for me in terms of competitive advantage. It's not that obviously the infrastructure provides Amazon with a massive like logistics advantage and ability to deliver things quicker, but we're seeing to some extent, at least just purely in the news and the buzz, they still have to win online. Like, they still have to win customers on Google search. They still have to win against other online competitors like, low cost providers like Temu. And I don't know, Costco seems unbeatable because of their physical footprint, and the advantages have just been self-reinforcing for 4 decades now. Maybe it's just more proof of durability at this point, but feels like there's pretty much nothing that could disrupt Costco, whereas you could maybe come up with a case of something disrupting Amazon.
Sorry, I had to cough. For anyone watching, I hopefully put myself on mute.
Obviously, the growth potential is higher at Amazon just because of market penetration.
Yeah, clearly both are really solid, but I think I'm going to edge Amazon here simply because the growth rate's more attractive to me. E-commerce is still only in the United States at 15% of retail. And if you look at some of the other markets, well, I guess every geography, it's not guaranteed to hit where every other geography is, but given how popular it is among younger people, I would expect it to be probably 30 to 40% of the market over time. And I don't think Costco has that runway for growth just from that industry perspective of where things are transitioning. But both are clearly solid, and Costco still has a lot of potential left internationally as well. It's a tough one, though. They both have very, very strong moats, so I don't think you can go wrong with either. But both, I think, deserve a pretty high multiple, I would say. Yeah, everyone complains that Costco trades at 38 times earnings, 40 times earnings. I don't know if I would pay that much for it, but I don't think I would be selling it if it was trading at 30 times earnings, 32 times earnings. I wouldn't, right? There's a reason Munger says he's never selling it. Now, if we look at the earnings, it wasn't earnings. It was they do their monthly updates. So they gave out their comparable store sales for the 5 weeks in September. Comparable store sales in the US up 3.2%, Canada 6.7%, international 10%, blended company 4.5%, and then e-commerce 3.7%. So e-commerce not really gaining share, probably losing share if I'm thinking of the Amazon and Shopify numbers there. But everything else seems solid, even as we're going through a bit of a bullwhip on the consumer spending compared to 2022.
Yeah. It's a fantastic business.
Now, do I think it deserves 38 times 38 times earnings? I don't know. I'd rather buy.
Maybe it deserves it, but that just means the expected return is going to be lower. Should be.
Yeah.
For most of the, it might deserve it, but I don't want to be a shareholder in the situation. And I think if Munger were put in the situation now, yes, he's not continuing to hold it, but I don't think he's buying it. There's like that kind of that concept of, I think Munger was the one that talked about it with like marriage, like before getting married, have your eyes wide open, but once you're married, you can squint a little,
right?
You can like let things go, but be looking for red flags prior to it. That's kind of the same with like the company. Be looking for all the red flags prior to owning it, but once you own it, you can let the multiple run a little bit. Like just continue to hold it.
Yeah, I agree. And the way I would look, okay, it's going to grow, right? Obviously, but from a opportunity cost perspective, from hey, I could maybe find something else. There's a lot of optionality there, especially if the broad market falls. Costco's likely going to fall as well. I'd rather at this price or own short-term treasuries over buying it, right? Like buying it. But I agree with you. If I'm holding Costco and I've owned it for 10, 15 years, here's a good question. Because eventually you have to sell something, right? If it's trading at 100 times earnings, something like that, super extreme. Assuming normalized earnings, what multiple would you sell Costco at today? And I think it would be around, and again, this is not buying. This is if I bought it before and I'm selling simply due to valuation. I think it's probably in between 45 and 50 times earnings. What do you think?
Yeah, I was going to say north of 40 times. For me, I'd probably be selling it, because sometimes when you get a company that ratchets up to a 40 times earnings multiple or even above that, you can kind of rationalize some case where they grow into that. But for Costco, it's really hard without just extending how long you're going to hold it. It's really hard to like increase your expected growth rates unless inflation's insane. So
Right. Yeah.
it,
Okay. Or go ahead.
I think north of 40 times, it doesn't feel very attractive to me.
Right.
But
All right. Anything else there? I think we can move on to the what I may call the sexy topic of the week, which has been all the talk of the investing business finance world, and that is the new Michael Lewis book, Going Infinite. I guess he doesn't need any more marketing on SBF, and the trial's starting this week, which is exciting. Did you see the courtroom case drawings, sketches? He got a haircut. He looks like more of a criminal now. I think that was a mistake by their lawyers.
I did not. I saw some pictures, I think, of him coming out of the courtroom.
Yeah.
Right? Was it the same stuff? He got a haircut. I didn't check out his haircut too closely, to be honest. There have been a lot of interesting pictures coming out of it. There's been good coverage from the Wall Street Journal. There's honestly, there's a podcast out that's called The Trial of Crypto's Golden Boy. That's, I think, kept up with everything pretty well. And it kind of shares interviews from SBF from back in the day. And I've been listening to that for probably most of my coverage, and it's pretty entertaining. Did you see the list he made for dating the CEO?
I did not look at it, but I saw people were discussing it. He's a strange character. I don't think we can really, you're not guilty for being strange. I think you're guilty for being a
ethically
criminal
compromised
and hurting other people and stealing their money.
Okay, so let's talk about the Michael Lewis stuff.
Yeah, the book's out. He's on the press tour. What has he been saying for any of the listeners here?
Well, there's been a couple interviews now where he basically says, unlike Bernie Madoff, which was a Ponzi scheme, this was the FTX segment, the exchange, was a real legitimate business. And so was the hedge fund. And he kind of defends him in saying that if it weren't for the run on customer deposits, they'd be fine. And if it weren't for him to make risky bets in the hedge fund, he'd be fine. And he even went as far in a recent interview as to say the lawsuit against him kind of makes no sense. But what bothered, first of all, Bernie Madoff, there was a legitimate operation. They were one of the biggest market makers as well. His sons ran that on the floor below. So not entirely a Ponzi, but Bernie Madoff's operations, yes, Ponzi. There's a moment in one of the interviews with, I can't remember who it was. It wasn't the 60 Minutes one, but there's another interview where he's like, he was making big, bold, risky bets, but the lawsuit kind of makes no sense. And then he says, yeah, but he was transferring money that wasn't his, right? The interviewer asks him, he's like, well, yeah, but that's not, like, he shrugs it off. I'm like, okay, well, that's the biggest part, is that he was making risky bets with money that wasn't his.
Right.
And he seems to just kind of ignore that. The cynic in me thinks that he's getting paid a pretty penny to write the book.
I'm trying to figure it out, and I think here's actually, you finish, and then maybe I'll go through my thoughts.
Yeah, like I can't understand his perspective. I'm having a hard time doing it. Matt Levine lays out a pretty good case throughout his writing that it's going to be hard for SBF to get out of this. And Michael Lewis is kind of just omitting the lawsuit, and he's really defending him publicly. And I don't get it. If he's trying to sell, people have said, like, maybe he's trying to sell more books by having a different spin on things. If he wanted to sell more books, he would go out there and say, oh, the fraud is so much worse than you know. And he would pander to the audience which is most Americans at this point, that already don't like him because he stole people's money. He wouldn't go out and defend him because it's made me a little more reluctant to read the book. I don't want to get 50 pages through this thing and just be shaking my head like, why are you defending him? So
yeah, I'm not going to buy it. I am going to be buying or reading Number Go Up: Inside Crypto's Wild Rise and Staggering Fall by, sorry to the author, but his name's Zeke Faux. Zekefaux is his last name. I'll be reading that instead, as I think it's a more measured take on the crypto industry, although it might just be confirming my bias. But I am very curious on why he is so. Well, yeah, why was he so why is he defending him so much? Because it's pretty clear to everyone else that there was a big crime here unless other evidence comes to light.
Okay, from all the coverage I've seen from the Wall Street Journal, there was a direct, literally just a couple lines of code written to direct payments from FTX to Alameda. Boom.
Yeah.
That was not their money to bet. Right? Isn't that it? End of story. And they're gambling it. They're not only gambling it, but they're paying $15.7 million to Kevin O'Leary for 20 hours of work, paying $55 million to Tom Brady for a week's worth of work.
Well, that in itself is not a
giving
crime,
away
using customers' money to you're right. It doesn't, that's in itself not a crime, but it doesn't matter exactly what they're giving it away as. That would be just bubble behavior from a company, right? If they got it from a VC.
But what I'm saying is it wasn't theirs to give away. Not only gambling, but essentially giving it away to make Sam Bankman-Fried lifestyle better, to allow him to be in better social circles. Maybe you could call it marketing budget. But there was so much ethically wrong with this, and I don't know how Michael Lewis is just ignoring it.
Yeah. Looking back to those Super Bowl commercials, pretty wild stuff there.
Do we, first of all, shout out Taylor Swift because she turned down money from FTX?
Yeah. Well, I heard that was maybe not true, that was like a fake story. It's confusing.
Really?
Yeah. I think so. I think
something that like a lawyer intervened or something and was like, ask him if these are registered securities or something. Maybe it was a fake story. But to the people that pandered this stuff, Kevin O'Leary already didn't really like him to begin with. But Tom, come on.
Well,
actually,
55 million. I don't know, man. I think it's fine.
I think anybody would.
I would do that.
Give up a week for 55 million.
Yeah,
but that is insane amounts of money for marketing. Really, was it even marketing? I don't remember the commercial, so maybe it was more just to hang out with Tom Brady for a week.
Now, remember, it was the commercials where they're saying, don't be like X and don't be like all these people. Everyone, you got to get into the future, start using FTX. Yeah. I think what's key here for especially the people that were collateral damage, and it kind of maybe leads to my Michael Lewis take here, is that it's pretty, unless you follow this closely, try to research it a lot like we do. I don't think it's crazy hard to understand, but if you're just on the outside, you can go, well, this is super confusing. I don't really know. I'm just going to trust the industry people to tell me that it's okay. Right. So I don't really blame all the celebrities, right? Maybe Kevin O'Leary, because he seems to be supposed to be, right, a shark on a TV show that I would not watch if you were a serious person. But
the other thing,
or go ahead,
that I found funny about the coverage, and this doesn't really have to relate to the Michael Lewis stuff, but from the Wall Street Journal coverage, something they talked about that was interesting is when FTX collapsed, they realized they had whatever $8 billion, $9 billion hole, which they'd been paying out customers' money to Tom Brady. They created an 8 billion, I think was the final number, hole. And first of all, they were using QuickBooks. There was money that was unaccounted for. They had a hard time figuring out how much they owed. He sends a message to CZ at Binance like, fine, you won. I'll allow you to buy us. And then CZ is like, okay, we'll send our lawyers in and our accountants or our auditors. And he's like, and he determined pretty quickly that Like, this is unbuyable. There's so much unreported here. There's a way bigger hole than people are accounting for. And CZ had called it off. Like, there's no way this is happening. Sam Bankman-Fried had no idea for like a while that Binance had called it off. That like that CZ was like, no, we're not buying you. And so he sends a message kind of before it's supposed to close, like, hey, there's been a lot of rumors that he might be backing out. Just want to double check. He's like, no, like, we're not buying you.
Yeah. CZ is let's say, well, we'll let the courts decide, but he's been alleged of a lot of crimes as well. And I would think I would lean on the side of being guilty, but it's also TBD. We should say here. But at least he seems like he's professional, right? And he actually is trying to run some sort of business operation here. But we'll see what the hell happens with Binance. What I want to talk about with Michael Lewis, though, is I think looking back on all his different books now, if you look at Moneyball, okay, if you kind of look back on it and you follow baseball, I honestly don't think it had that big of an impact. The teams didn't actually do that well. It wasn't some sort of miracle thing. Yeah, you're using stats. Crazy. If you look back at the blind side, there's actually been stuff that's come out recently saying that the family screwed that guy and were actually terrible people, which, again, we'll see actually what comes out to be the truth, but not really good for Michael Lewis's investigative journalism there. Then there's Flash Boys, which when you read it, and you don't understand the industry, you go, dang, that's crazy. That's evil. We should get rid of this. Actually, I think the high frequency traders are providing a lot of value once you actually understand what they're doing. And now this, I just don't think he understands the stuff. And he's just being very gullible. I think that's the key here.
Does write a good story, though.
Not since The Big Short.
It's not, maybe not accurate.
I haven't liked any of his books since The Big Short. They're not. I think I haven't
read any of them since.
He's half-assed The Big Short's great.
What's come out since The Big Short?
Tons of stuff. There's like one covering government and agencies like the Department of Energy, Flash Boys. This one, maybe one more.
Flash Boys was after.
Yeah, The Big Short. Also, The Big Short. Michael Berry. You could have talked about how he was crazy. Maybe he wasn't crazy then, but the guy, right? Like that also has come out as he is
a little politically insane.
Yeah.
It hasn't come out. He just started tweeting and everyone's like, oh my God, this is not Christian Bale.
Yeah, exactly. So the portrayals like, right. Like, I think that lines up where, okay, maybe we shouldn't trust this author that was put on a pedestal for these type of stories anymore.
Yeah, I think that's fair.
All right, we got a question here from John again. Thank you for being one of the few joining us here. It says, look forward to listening to your podcast on Adyen. I would say that is out. So go check that out wherever you're listening. Could be on the YouTube channel, Spotify, Apple, wherever. But he has a question on Boston Omaha. As one of their co-founders is also on the board of Nelnet. Do you see similar success in Boston Omaha? Both are companies that are kind of the baby Berkshire model, right? They're trying to be a conglomerate. They're trying to just provide value to shareholders, right? They have a very open mandate on what they want to do. What makes us like Nelnet over Boston Omaha is the track record. Nelnet has a 20 plus year track record of compounding shareholder value, of growing their book value per share, which is probably their most important metric as a financials company. And Boston Omaha, I wish them all the best. I hope they do provide value for shareholders. They don't have a track record and their performance hasn't been that great. So with these conglomerates, it's all based on the track record. And when you're small, like if you looked at the early 80s with Berkshire Hathaway, yeah, like, or even earlier, you could have said, hey, they have a pretty good track record here. I'm going to bet on them. You still have a lot of runway left. I think betting on someone before they prove stuff isn't, I don't know why I would do that. What is attracting me there when they don't have the track record yet? I just don't understand.
Yeah, I think I like Adam Peterson and Alex Rozek We went to a shareholder meeting for Boston Omaha. I thought it was solid. They answered a lot of the questions the best they could, and they seemed to run their business pretty well. But to be honest, there were some red flags. We didn't even talk about the fact that SPAC has basically amounted to nothing.
Right. The
And
pre-revenue company, that was a bit scary.
yeah, like people gave a lot of flack to everyone else that took all the SPAC fees on these pre-revenue companies that weren't really legitimate operations yet. And Boston Omaha, I mean, granted, I'm sure they got some nice fees from it, but they did a lot of the same stuff. And they
Yeah,
really
wow.
they really tried to, like, I don't know, they tried to sell like the story of the founder and stuff like that. And it kind of came across weird to me. But the other biggest difference that I see between Nelnet and Boston Omaha is that I like Nelnet's core businesses better. I like the student loan servicing. I like the business software specifically a lot better than the billboard business, which is really Boston Omaha's, I believe, their biggest cash cow. So it kind of, for me, I think they have more predictable cash flow moving forward, that management has done a good job reinvesting in the past and should continue to do a good job reinvesting. Whereas Boston Omaha might just not quite have those same levers or the same. I just don't have as much optimism about the businesses under their portfolio. I still, like I said, though, I'm wishing the best for Boston Omaha, and a lot of friends are shareholders, so I don't want to hate too much on it, because
Yeah.
there's a lot to like there, and they seem like honest management, but it just
Yeah.
wasn't. I think there's differences between them and Nelnet.
100%. All right. We had a comment here from Andrew Marshall over at Capital Mindset. Said, saw your guys' segment with John Rotonti. Liked it a lot. John, we do have an interview out with him today, and he is launching his own podcast. We have been, I would say, trying to promote it because we're working on it with him, but it is called The J Row Show. Let me just put a quick advertisement in there. And it is a fantastic podcast covering, he's basically going to be interviewing masters in their field, going to be, kind of people that have put in their 10,000 hours. For example, the first episode is with his long-time friend, Bill Nygren, a legendary value investor who has been in the industry for decades. I really enjoyed that episode. It's going to be longer form. It's going to be out every couple of weeks. So if you like our show, I'd say go to the J Row Show, either on Apple, Spotify, YouTube, wherever. Follow it, listen to the stuff, help support it. Also, Andrew says Sprouts Farmers Market seems to be crushing it since we talked about it. And for anyone that doesn't know, we went on the Capital Mindset YouTube channel and talked Sprouts Farmers Market, which I believe will be released to the public shortly, although that's all up to them. Or it might be out already. I didn't check. But that was really fun. And yeah, what do you think of, because the Russell 2000, a lot of small caps, micro caps have gotten beat up compared to the magnificent seven, as a lot of people are calling it, right? The big tech seven. But Sprouts is doing really well. What do you think about that? It seems like the valuation is honestly getting a little bit stretched. How do you think about that when we don't have any of the numbers yet? We're not people that are getting all the like alt data, stuff like that. I mean, any lessons there? Anything that's kind of coming to mind?
I don't know. It honestly makes me a little bit wary, just in that it's not really performance related, because nothing new has come out since the stock went from 34 to 42. So, and buybacks were kind of a big part of our thesis. So it's going to be harder for them to buy back creatively. However, I do find it kind of interesting, and this is good timing. They were buying back at depressed levels partly because there was a lot of supply chain issues, and they were getting the excess cash, and they really didn't have anything to do with it in the meantime, because they weren't able to build out those stores. So they couldn't put as much money into CapEx as they wanted to. So they were taking the cash, just buying back their stock every week. Instead, now they're finally in the position where they can ramp up store count, and the stock is getting stretched. So now they're going to get better returns putting money into new assets than to buying back their stock. So it's kind of working out at a good time. However, it does concern me just anytime I see a stock I own ripping and it's not performance related. It kind of concerns me. So I try to sell less and less. I think we've tried to be less active. And when stocks start ripping it, I don't know, it starts to encourage like activity for me.
Yeah. Yeah, I agree. I'm in that same camp. Sorry, I'm just putting the link to Capital Mindset for anyone there. That is the link. For anyone that's listening to this, you can go look it up. It's on YouTube, and I'm putting it in the live chat during the feed.
I want
or go
I
ahead.
want to go
Other thing,
over I want to go over this Mobison paper, unless you have anything else.
on Sprouts, yeah, I mean, we still got like 25 minutes, so should be plenty of time on Sprouts. I think what's interesting is if no news comes out on a company and it's kind of going against its factor, my assumption is usually that someone's seeing something positive, or if it's, underperforming, way negative, right? If there's no external thing there. And for this one, it makes me think that, right, someone's seeing something positive here. You never know. Could be just someone wants to buy it, but yeah, that's kind of what I think in general. Like, because there's a lot of data out there that people can get on these things. So I think honestly, that's the most plausible thing.
It's funny that for Sprouts, stock starts ripping when everything else is stagnant. I start to think, wow, someone must really know something that warrants this. But when it starts to go the other way, I'm like, yeah, brainless Mr. Market is selling off good businesses as opposed to, yeah, they probably have some alt data that's showing bad results.
Yeah. Well, it really depends if it even matters, because if someone's like, oh, they're going to beat, I don't really care. For Sprouts, I guess if they're seeing traffic acceleration, that'd be a positive sign, but it's more of, okay, why is it going up? Doesn't necessarily matter. Why is something going down? Doesn't necessarily matter. Although, if it's going down, it could be beneficial because you can buy back at a cheaper price. I think the big lesson I have from a stock like this, as one of the ones, I guess the few of the stocks that we've owned that have done well in the last couple of years, is that when you buy a decent business at a very, very cheap price, it's hard to lose. And management just doesn't like the money they get on fire.
Yeah, we do have some questions. Tony asked, did you guys already talk about Spotify audiobooks? No, we haven't yet. So maybe I'll just hit on that first. This week they announced, so last year they kind of rolled out this audiobooks feature on Spotify, but it was basically not that different from any other audiobook platform, which is you just buy each book individually, a la carte. So it wasn't bundled into the subscription at all. But this week they announced that they are going to be including audiobooks in the premium subscription. So it says, here's a quote from their press release. It says, to start, we're offering each premium individual as well as plan managers for family and duo accounts 15 hours of listening per month, making more than 150,000 audiobooks available. I like that they're differentiating in some way, and this is probably the best way to drive real audiobook listenership and diversify consumption away more so from music streaming. So I like it. I haven't thought all the way through it yet in terms of how it might impact Spotify's business. My initial thought is that it's going to take a while before this trickles through into anything financially.
Yeah, I was making jokes that it's going to have low margins. It probably will, at least at the start. They're just trying to launch with some deals here, and it's not going to have any impact financially for many years. But I think it can be very positive from a churn reduction standpoint, because, okay, who's their biggest competitor? YouTube Premium, right? YouTube Music, whatever you want to call it, around the world. They don't have this sort of feature. And if I'm someone who's thinking, okay, well, I can get YouTube Premium for whatever the deal they have with, you bundle in stuff that's not even the music. For me, this could, I think, provide a lot of value for myself. And I'm just thinking personally, I like that service is going to be on there for premium subscribers. I think it gives them more pricing power, which they're not going to make money on the audiobooks per se, but they're going to make more money on the music. So yeah, I like it a lot. I don't think it changes much though. And they did talk about how it's been a long time coming. So it looks like they had to go through tons of negotiations here. So I think it's going to be similar to the music business, low margin. You got big suppliers. They have kind of the labels are similar to the publishers. And that doesn't mean it's a bad business because the unit economics on music are, I think, much better than people think. But we'll see what the final product looks like.
The other thing I'm just thinking through now is if you're only getting 15 hours and you get halfway through a book and you're halfway through a month, probably going to spur more audiobook purchases or a la carte audiobook purchases. So
yeah, and
I imagine that helps drive some revenue as well.
Yeah, and I believe you can add hours on a sort of a la carte basis for, I think it's like $10 a month to add 20 hours more, something like that. I'm sure that's just what they had to negotiate with the publishers or whoever you call them. I forget, Random House, Penguin, Simon Schuster. I think it's clear though that their goal is to offer unlimited audiobooks, right? That's what they want because that's what they would be want to offer, similarly to music, but I guess they couldn't get there.
Yeah, but it's like, okay, look how much value we're adding to the subscription. And this is really valuable, I think, from a consumer's perspective. Like you're not paying any more and you're getting access to a bunch of audiobooks for free. Not free, but included in the subscription. So you'd think, wow, that's really going to raise potential pricing power. And you just don't.
But they're very patient. Well, they just raised. So, but yeah, they're very patient with that.
For the first time in
forever.
15 years, 16 years since they launched, they raised the price of their individual plan. That is true.
Yeah. So, I mean, you could argue, okay, there's a lot of pricing power left, or there's a lot of ways you can go about that. You can think about that optimistically or pessimistically.
Yeah. You know who this helps? Probably Warner Music Group and all the big labels.
Yeah.
Because it allows them to raise prices. And if they're still getting that 75% chunk, well, I guess it's still prorated based on listenership, but maybe it doesn't help them that much. I wanted to talk about this Mobison paper because we got 15 minutes left. Long paper. I think it was like 50 pages or something like that. On slide 37, there's this list of wide moat businesses from Morgan Stanley. And I think there's about 100 companies on this list. I'm not going to go through all of them. Maybe Brett can share the screen. Maybe some of the ones. Maybe I'll just name off a couple. Adobe, Amazon, Altria, Blackstone, AutoZone, Autodesk, Danaher, Estee Lauder, FICO, Intuit, Intuitive Surgical, Philip Morris, MasterCard, all those. Something that stands out to me, because we were talking about this earlier on, is that Costco is not on this list.
Well, maybe they just disagree or didn't include it for some reason, but it's one that you remember it's one that always comes to mind. So I'm curious why they wouldn't include it.
Yeah, it seems strange to me. Were there any here that you see and you think, that might be a little premature?
I'm trying to look through. One that pops up to me is Live Nation. But, maybe they have a strong moat, but I just don't know if that business is that profitable. I mean, Tesla, they're still very early stage, right?
Tesla, sure. The Evolution.
But everyone, Evolution. I think, we looked at that a while back. I'm sure the business hasn't changed that much. Extremely high profit margins, but I'm not sure exactly because they've seen some customers go in-house, right? For that, basically trying to do this themselves. I'm not sure how much of a moat that has, but I'm curious. I would love to have someone on here talking about it.
Yeah, I think for the most part, these make sense. I will note there's a lot of tobacco on here. That makes sense to me. There's a lot of companies that we've done recent episodes on. AutoZone. We did a show on Autodesk. How do you think this list of 100 companies performs against the S&P 500? over the next
Who
10 years?
equal weighted? I think it probably tracks because it's too big.
Yeah, I
Probably
think
tracks.
this probably makes up the majority of the
Yeah.
S&P 500 anyways. So
I like seeing Bolsa Mexicana SAB. I believe that is the stock exchange in Mexico. Seen some interesting pitches on that over the years. I honestly wouldn't mind doing that. I know we would love to do a Mexico themed month, but not sure how many people actually care about that. Maybe anyone let us know, honestly, if you'd rather do a if you think that would be fun, because we don't know if we kind of get worried that people won't listen to that. What do you think? Any thoughts there in general on
I
the
think it'll
companies?
take a lot longer to do the research because some of those investor relation pages are tough.
Yeah.
I remember looking at the Mexican airport operators, and those investor relations pages are a disaster for an English reader. And sometimes the translations aren't exactly right, so kind of makes it tough. But we do have some comments here. Fake Alias says opinions on physical retail companies getting very cheap from shrinkage, interest rates, and recession narratives. Do you think there are attractive opportunities currently, or is it a trap? I kind of don't know what to think about this shrinkage issue because it it's for a lot of these companies, it's not really solvable. A lot of it has to occur at kind of the local government level, I would believe. So I think if you're just bringing your stores out of there, I think it probably helps the discount retailers that don't really operate in those spaces, that aren't in like the big cities, which it sounds like Target. Who are the other companies that were pulling out of some of the big cities?
Just the
I
big
know Target was
retailers
one of
that,
them.
yeah, just the big Target as an example, or Target as businesses, big box retailers that you classically see across all sorts of cities in the United States. I don't, a little teaser. We're doing some discount retailers for the month of October, which will be fun. And maybe we'll have a better conclusion at the end of the month, but it's hard to, for me, it's really hard to get any sort of take on, okay, is this problem going to get worse or better? I don't know. It seems tough.
Yeah, I haven't really looked at them as a bunch, like as a collection. Margins seem to have compressed kind of across the category, which feels like that might be kind of here to stay as long as the consumer remains a little pinched. It's been interesting to listen to the Dollar General. Spoiler alert, we're going to be talking about them next week. Dollar General CEO kind of commenting on the consumer and how difficult of an environment it's been. So I worry a little bit, just given the consumer right now, that margins are going to be anywhere near what they were getting when discretionary items were so strong. Because, I mean, 2021, electronics were one of the best selling categories at a lot of these big box retailers, especially like the Targets of the world. And they can really mark those things up on discretionary items, where it's a lot more competitive when grocery and critical consumables or non-discretionary items are the major driver of traffic. I don't know.
Yeah.
That's my haven't done enough looking opinion.
Yeah. What's funny is that the Dollar General, they get constantly asked, what's the health of the consumer? And they're like, well, our consumer is always unhealthy. That's the point. So what's interesting is that the discount retailers tend to do well during a recession. It's just hard to tell what, I think a big question is, given that they probably over earned on a margin standpoint during the pandemic, is what will the margins look like going forward, given how expensive labor is now, which is a huge part for them. And given how, some of the inflationary inputs, blah, 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 the shrinkage, how much is that actually going to affect them? But I think, yeah.
There's a comment here that says we should look at Thermo Fisher or Danaher.
Have tried. It's very tough. I think I'll let
Yeah.
some other people make money on that. Honestly,
I think
it's
that
too
just
hard.
goes outside our circle of competence, especially. I think anything healthcare related, I tend to just say no.
Yeah, it's too hard, and there's so much
I know it's
innovation in this
equipment, but
industry, and there's so much, right? Like, It's just
There's
a
also so
very,
much regulation, so much like
so much change
which
in regulation. Yeah.
maybe Thermo Fisher and Danaher are beneficiaries of that, but I don't understand it enough to feel comfortable owning any of them. We do have tons of questions, I guess, in the chat here. Shoeless Joe is talking about SoFi. He says, for me, the tech platform is what can transform SoFi from an okay bank to a great bank. Do you agree? How long do you think it could take to see real results in this area? I'm not that familiar with the platform, like user interface, but the people I know that use SoFi really just do it for the APR, APY, sorry, the rate they get on their savings accounts, which by having a good tech platform and not having physical branches is a competitive advantage versus the legacy players. And they've done a really good job at attracting deposits, which I think is probably the thing that's most exciting to me here.
I
do
wouldn't say it
worry.
makes it, I would be, that theory makes sense. I would not have much confidence in it. Wait for it to play out. You should not, I would not have high conviction in that, but hey, it could work.
I believe in the digital advantage for some of these banks.
Yeah.
But I don't know. With SoFi, it feels weird because they report like a tech company, but they're really at its core a bank. And so it's hard to get any sense. We looked at it and then we talked to Brad, who owns it, and looked at it again. And my biggest takeaway was that I have no idea what they'll earn. I really can't get a sense of what will be shareholder profits.
Yeah, it's just a big TBD. I think it's a risky stock, and maybe the reward makes sense because it could be a much larger business someday. It's one of those where if you want to make a small bet on it, great, but I have no thoughts. It's how can I predict this at all? There's no sense of that. Maybe you can predict that deposits will keep growing, but their profits and growing book value per share, which I believe hasn't been very strong, but let me actually just confirm that.
What do you think of the new what's his name? How am I blanking on this? Bill Spackman. Bill Spackman's Ackman.
Sparkman.
Yeah,
It's
what
an
do you think of his new SPAC?
Interesting concept, and I should say that if our source here is correct, which again, we're not calculating this ourselves, SoFi's book value per share has been pretty stagnant. So I'd say, look, you got to see eventually changing performance there. The Spark seems like a fine idea. It's kind of weird, but
What would
nothing
you
wrong
think
with
if
it.
they took X public?
Good luck. The business seems to have collapsed from an advertising perspective. So yeah, good luck.
No external links either anymore.
Yeah.
Rip.
Look,
Rip to promoting the podcast on Twitter.
Personally, I'm extremely mad at them, and we have made them a lot of money over the years. So yeah, I think that's it, right? I think that sums it up.
Yeah, just about. What if you could have the Spark, SPAC, whatever vehicle take any company public? Is there one that you'd really like to see?
That I'd like to see?
Maybe a more mature business that's private.
Trader Joe's. Actually, is Aldi public? I guess that doesn't make sense because it's part of a larger business. Is Aldi public? What do you think? Right? I think that one, I'd love to see that one.
Yeah, there was
Aldi
rumors.
is not a publicly traded company. Okay, so Trader Joe's, no exposure. But yeah.
There was rumors a while back when Ackman had a couple of SPACs that they would potentially be taking Bloomberg public. That would be really cool. I think it's probably one of the most sticky ecosystems. That would be on the wide moat business list, I think.
Yeah.
If it were publicly traded.
Yeah, it's interesting there. For sure. For sure. I like Lego. Lego could be interesting.
Can you not buy that? I thought Lego was like a public stock.
Or is it no, I don't think so. Is Lego traded? Lego is not publicly traded according to Google, so trust that you will. Yeah, I mean those Lego just has tremendous pricing power.
Oh, you know what? That's what it was. I saw a tweet this week that was like, if you would have bought Legos, like actual Lego sets, you would have
Right.
tracked the general index or whatever. That would be a great one to see come
Exactly
public.
right. Nice pricing power. Matt H says In-N-Out would be fun. Yeah, bad products getting a lot of buzz, I guess. Right, like the burgers aren't very that good, and
I'm a
yeah,
hater. I'll say it. I'm a hater. Sorry to
exactly.
any of our California listeners, but
What's interesting is that I think that it sort of makes sense, sort of almost like Hershey, right? When we did a show on Hershey, people are like, well, the chocolate's not very good. And it's like, but that's kind of the point because it has one unique flavor, and two, even though it's bad, it's so stuck into the cultural whatever, it's so stuck within society and blah 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 that that's a moat within itself. And I think In-N-Out has this weird brand that I don't get it, but
people
that
love
could
it.
be a decent business as well.
These
Chick-fil-A,
are all the
everyone says Chick-fil-A, but that would trade at an absurd multiple because everyone's like, oh, have you seen their average unit volumes? It's like, yeah, but you're gonna buy this thing at 100 times earnings. I already know what's gonna happen.
it's like just
That
look at the TAM once they start serving on Sundays.
yeah, exactly. Exactly. Okay. Do we have any other topic? Let me just scroll through Twitter because I should have checked what I was interested in this week. Oh, the Google Pixel. I want to talk about that.
Yeah.
Okay.
All right.
So here was a report over in Japan I thought was quite interesting regarding the Google Pixel. So here's the quote. I'm just going to read it, 2 paragraphs. In Japan, which is the world's 3rd biggest economy and an important market for apps and games, sales of Google Pixel smartphones rose 6 times in the second quarter of 2023 compared to a year ago, according to research firm Counterpoint. Findings published by Bloomberg. This increased the company's market share to 12% from, I'm guessing, that like 2. While that's important news on its own, what makes it even more interesting is that Apple's market share declined from 58% to 46% during the same period, marking the first time in 2 years the Cupertino Giants' share has fallen below 50%. We just saw the Pixel 8 and Pixel 8 Pro releasing this week. They're actually going to be shipping for $700 and $1,000 respectively, a $100 increase from the previous versions last year. So they're on their 8th iteration here. Whenever they talk about the specs of a phone, I kind of just go, all right, you got this cool computer chip. I guess they have the Tensor chip from Google and they have all these features, right? Seems like the camera's great. Seems like they pretty much from a spec perspective may finally gotten to the equivalent of the iPhone and the Samsung ones, right? So what do you think? It seems like they're gaining a ton of market share here, and that could be pretty darn good. They're not going to make much money from it, but pretty darn good for keeping the search, the maps, the YouTube moat wide.
Yeah, I'm curious what the difference is between the Japanese market and the American market in terms of why Apple isn't, or the iPhone isn't sticking as much. Maybe they don't care if their texts are blue. As opposed
Well,
to
it's just one period, right? So we'll see. But because it has similar market share numbers than in the US, right? For consolidated, I know Apple has a much larger market share among younger people, 20 to 30s. It's like 80% plus, but in generally, they're like 60% right in the United States from a consolidated basis. So it was similar. And I wonder what, made that hit. Maybe, maybe it's just a one-time thing, or maybe the Pixels were cheaper. They liked it better. And they use WhatsApp instead, like most other countries do.
Yeah, that's true. I didn't think about the WhatsApp angle. The I guess it's time to short Apple, huh?
I mean, no, but there's some. What's funny is that I'm pretty not. I'm like
Worthless hardware company.
Yeah, they're pretty neutral on them, and I don't really like the stock at all at a premium multiple. But it's funny is I'm seeing a lot of people that are even more bearish than me, and I never really see that. There's always just the people that love it so much and hype it up, and I do think they have much more risks than a lot of the other big tech, excluding Nvidia and Tesla, who are, just at an extreme valuation. But for the core big five, I think Apple has much bigger risks from China market, the Google payment which looks like it's going to get litigated away, but TBD what happens on that lawsuit. Market share losses in the non-US market. There's just a lot here. And I don't know why you would. I get worried a bit. What's interesting is the revenue hasn't really grown that much in the last few years.
No, it really hasn't. Now, if you reference it back to like 2017 when Buffett was buying his stake, revenues come up a lot, but it's been a more of a mix towards services, which, being that it's higher margin, I think you're getting higher quality revenue. But as far as the hardware goes, they've seen a lot of kind of volume ebbs and flows across pretty much everything but the iPhone. So I don't know. Yeah. I'm not nearly as optimistic. I find it weird that it trades at the best multiple, right? Or the highest multiple among big tech.
Maybe
not so much anymore, but
I think you're probably right. PE 29.
Google's like 20.
Yeah, honestly,
a little higher.
They are
the most capital efficient.
Well, maybe not. Yeah, maybe just efficient. I would agree with that. Whatever. Yeah,
they are the most efficient with their cash flow.
Yeah, they're frugal. They're very consistent. They're not. I mean, maybe frugal comparatively. This isn't a Dollar General company, but frugal comparatively to the other big tech companies. They seem to have less waste, which honestly, here's what's interesting. And this is what Fake Alias here says. I know it's blasphemy to say, but I do disagree with Buffett on his views on Apple at this point. I kind of am in that camp. I think it's much more risky than he thinks, because he thinks the way he talks about it, he's like, oh, people pay $10,000 for this phone. But it's not like, I don't think that just applies to Apple around the world. Right now, they're the leader, but I don't, you know what I mean? Right. It doesn't necessarily refer to Apple. It doesn't.
I think the functionality, I think the functionality for any smartphone is worth more than it's currently priced for. But when you can pay it out over 3 or 4 years, like the Pixel is probably worth more than it's selling for.
Yeah, and here's what I thought was super interesting. I saw a take from someone else that I would say I'm completely stealing here, is that with all these new AI stuff, with all these new sensor inputs that are going to likely come for these phones, for these AI, what do you call them? The LLMs. I forget their acronym all the time, but everyone kind of knows what I'm saying here, right? The Chat GPTs, the Google Bars, et cetera, as they're advancing so quickly, and as they're going to basically help people with their daily lives, you want the phone to have a good sensory input for a lot of this stuff, right? And I think Apple is at a big disadvantage here versus, say, the Google Pixel as we go over the next 5 years, where you're going to want these inputs to come into your large language models. Apple doesn't have anything to help with that, and Siri is obviously terrible.
I say fade the AI assistants, man.
I don't know. Either way about the AI assistants, you want.
I think it applies to business. I think it applies to enterprises. There's good applications for it for Spotify using the voice generative assistant from OpenAI. That makes sense to me. But this idea that everyone's just going to be like, oh, I don't know what to do. Maybe I'll just ask ChatGPT for every single search query of its life. That's just not going to happen. I think ChatGPT's consumer sentiment peaked a while back.
Okay, here is a take from NCS Capital's newsletter. Maybe it's a bit of a take, but maybe not. Just kind of a thought. Says it's covering kind of that AI phone that rumoredly OpenAI is trying to look into. Says, and this is a direct quote: "The phone market is wide open for disruption as we move from multi-touch to a chat-based AI interface. Google is well positioned with its LLM efforts, but Apple could be vulnerable. The phone itself needs to become more aware 24/7 with vision and audio, and it will need to interface with AR glasses and provide more onboard processing. I highlighted this potential disruption back in April, and last week news broke that OpenAI's Sam Altman and former iPhone designer Johnny Ive are potentially working on an iPhone of artificial intelligence. Status quo will be hard to disrupt, but for the first time in well over a decade, there's a major UI transition opening a path for disruption. I'd say, not as a pun, be open to this possibility being a decent likelihood.
Potentially, yeah. Matt H says, "Watch yourself, Ryan. This could become your Krugman tax machine moment if you keep talking." Yeah, I don't want to.
I know. I kind
Don't
of
want to say
agree with you, but
anything too definitive. We
yeah,
are.
we did go long. I think
We're
that
4 minutes over.
So let's wrap things up. I think we'll probably be continuing to talk about the smartphone market share, which is really fun. But thank you everyone that joined. We go live Thursday mornings. We went early this time, but generally around 9 o'clock, 9:30, 8:30, depending on our schedule. Thank you everyone for listening. We are not financial advisors. Anything we say on this show is not formal advice or recommendation. We are general partners at Arch Capital, and clients may hold securities discussed in this podcast. Thank you everyone again for the comments and questions. It was really fun this time. We'll see you next week.